If you're anything like the numerous investors and traders that we talk to all the time, then you're frustrated by the pathetically low returns that you're making on your investments. I'm the head options trader on our options trading desk here at SMB Capital, and I can tell you that anemic returns are the number one issue on the minds of everyone attempting to generate reasonable income from their assets. The good news is that there's an extremely easy to learn technique for garnering a significant amount of additional monthly income from your investment portfolio. And if you're interested in learning that technique, then stick around. You'll be surprised how easy it is to learn and implement. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, you'll want to click our subscribe button right now so that you don't miss any of our free trading videos produced for the trading and investing community. Okay. So the technique we're going to describe in this video is called the covered call, and it is a very powerful technique for improving returns pretty dramatically on your investment portfolio. So before we get into that, let's just review the basics of what a call option is so that there's no confusion when I explain how this strategy works. If you already know how a call option works, don't worry, this will be quick and then we'll jump into the guts of the lesson. So what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is trading at before that option expires. The buyer of a call option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. But if the stock on the expiration day of the option is not beyond the strike price of the option, then the seller just pockets the premium that he was given by the buyer. He walks away completely free of any obligations. The option, in other words, expires worthless because it was never triggered. So let's say, hypothetically, that XYZ stock is trading at 100. So let's say that there's an options chain 30 days out from today for XYZ, and we find that the option to buy XYZ for $105 in 30 days costs 80 cents. Then that option would cost the buyer $80 because it represents the right to buy 100 shares of XYZ, and so you need to pay $100 times 80 cents to buy the option, so that's $80. Now, moving out 30 days, if XYZ stock closes on the day the option expires at 105 or less, the option expires worthless, and the seller of the option just pockets the $80, and the buyer of the option just lost $80 on the transaction. However, if the stock trades up to, say, 107, then the seller is required to sell the buyer his shares of XYZ company for $105, even though they're trading at 107. So in that case, the buyer would make a profit from having bought the call because he paid $2 less per share for stock than it's actually worth, and he paid 80 cents for that right, so he made out on that one. So those are the basic dynamics of a call option. Okay, so now let's say you're an investor and you've decided to construct a portfolio of 8 stocks that represented more than 90% of the business sectors that comprise the S&P 500 index, as you can see. So you buy 100 shares of a stock that represents each sector. You'll recognize some of those stocks: Apple, Intuitive Surgical, Goldman Sachs, and the others. You'll see the dividend yields on those stocks on the far column ranging from 0 to 4%. So if you do the math, you'll see that the entire portfolio would cost $163,400, and its dividends would net you about $2,200 for the year, which comes out to a 1.4% yield on your portfolio. But what if instead you decided that you want to really significantly improve that portfolio return? Well, you might decide to engage in a monthly program of what options traders refer to as covered calls. Let's take a look at how that could come out. Now, before we get into how the use of the covered call can make a huge difference in the income you'd be able to get just by collecting dividends from these stocks, I wanted to mention that we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 additional real-world option strategies that our traders use, including a really simple and effective strategy that some of the greatest investors in the world like Warren Buffett use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. And if that would be of interest to you, then you should check out the free options class that we're running right now. So just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open a free registration page in a new window, so don't worry, you won't lose this video. Or you can just head over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. So now on to our plan for a covered call campaign, which would be as follows. Each month, 30 days before the monthly expiration, we'd sell a call 5% above the market price of that stock. So let's take Motorola, for example. On September 19th, we were 30 days away from the October 18th, 2019 options chain for that stock. Now on that day, Motorola was trading at 168. So if we went up about 5% to the 175 call and sold one of those, then we would receive $166 for doing that. Well, if we did that same thing, that is, we sold a call 5% above the money for the options chain 30 days out on all of these stocks, this is how much income you'd bring in that day across all the stocks. As you can see, you bring in about $2,000 in 1 month, when it would take a full year to collect about that same amount from the dividends thrown off by those same stocks. That is a pretty big deal. If you go further and assume you do this every month and receive about the same premiums each month, here's what the outcome would look like. If you continued the program for 12 months, you'd receive over $24,000, which is an annual yield of 15.1% versus the annual natural dividend yield that your stocks are throwing off of 1.4%. And don't forget, you're still receiving those dividends for as long as you hold on to the shares, which means you'd most likely make over $26,000 on your $163,000 initial investment, more than 10 times what just collecting the dividends would have yielded through an easy implementation of a covered call program. So what I'd like you to take away from today's video is the fact that you are not captive to the ultra low interest rates and dividend yields that are being paid out to investors these days. There's an approach, covered calls, where you can enormously improve the cash yield on your equity portfolio simply by understanding how options work. As long as you own those shares, your broker will allow you to sell calls against them, resulting in a much more attractive use of your assets than buying equities with anemic dividends for the portion of your portfolio that you're investing in the stock market. Now, just to remind you, as I said earlier, if you enjoyed this video and would like to learn 3 more real-world option strategies that professional traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open the free registration page in a new window so you won't lose this video. Or you could just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now it's your turn. Why don't you take a look at your portfolio right now and then look up the call price for an option that expires in about a month that is about 5% above the current stock price. You can find these prices in Yahoo Finance and plenty of other places. Then leave me a comment and let me know, would you sell a covered call on this stock every month? Or would you rather just continue receiving the dividend? I'm curious what you find out. You might find it eye-opening.